All right. Welcome to. I guess this would be my first actual educational video. I have no script ready, and quite literally don't care about like a microphone or whatever. I'm gonna be dropping info. I'm gonna be dropping gold. If you want to use it, then I guarantee your improvement. I'm not gonna guarantee your profitability. That's up to you. You won't have to be the one who puts in the work. But I am going to guarantee that selling this will change your perspective of price. I want to go over five important points here, and if there is more that I do need to add, I'll definitely go ahead. I want to start with what is liquidity and why does it exist and why it matters. Let's move on to price. Liquidity, if I want to be as simple as possible, is where traders put their stop losses. Now, we know it's not that simple. Why it exists and why we need to pay attention to it and know that it is important. Uh, so, when you want to buy, let's say you're a normal trader and you want to buy 20 lots, you're obviously going to get filled in instantly. You know that. And we know that price is algorithmic, and we know that price targets liquidity. Okay, but why does it target liquidity? Why does it price aim to stop us out? And there are multiple reasons for that. Well, the biggest one, and the only one that you need to know, is the fact that when big banks or institutions, let's just to simplify this, let's say BlackRock wants to buy Nasdaq. For one, they're going to enter with I don't know, fucking a million lot size. Now, obviously, that is not something they can do instantly. We small traders, when we want to get in the market, we we get filled in instantly. When it comes to the big players, they are not able to do that. They need to buy when there is a supply, when there is enough supply for them to get in. That's where liquidity comes in. Essentially, when us traders are stopped out and a portion of, let's say, the supply is freed, that's when they can enter. And the algorithm tends to target them. Now, obviously, the algorithm has many more things to do, such as um, rebalance price or move price into a discount level or premium level, because, because obviously uh, institutions don't want to buy expensive things. They like cheap things. That all links into liquidity. I'm going to start here with what does it matter to us. We went through the first two topics. The second one will be, or the next topic will be, why does liquidity matter to us? Because we want to be trading against liquidity and we don't want to get stopped out. We want to buy where buy stops or sell stops are taken because we were in a buy position. In order for you to get out, your position needs to be sold. That's why it matters to us. If you buy below a low or a swing low, or let's just get started with how can we identify liquidity? I think it's pretty simple. I think a lot of you watching this already know. Swing lows and swing highs are where liquidity resides. A three candle pattern like this one, that's a swing low right there. Now, why swing lows and why swing highs? Why not just candles? You may ask. And I've never seen a YouTuber or a mentor mention this. That's because swing lows like this, they define the lowest point that price has went into at a certain time. For example, the swing low. If you just come over here, price comes down here, sure, a lot of traders get stopped. But this here, if I mark this out, this is the lowest point in price, or the lowest point price was driven into at this time. When price goes below that, many people get stopped out, and the algorithm enters a level of discount. Why does it enter discount? Because it's below where price previously was. Now, you may ask, well, does that mean every swing high and swing low is liquidity? Yes. Yes, every single swing low and swing high is liquidity. This right here is sell side liquidity. This right here is buy side liquidity. This is buy side. This is buy side, and so on and so forth. And as we know, price is fractal. It means if you go on a 1 minute time frame, every swing high and swing low has liquidity, or is considered liquidity, which is why you may see turtle soups or liquidity rates on the lower time frame, and then see price retrace or reprice. You can see, for example, in this point in price had a clear target down over here, turtle soup or a liquidity rate moves lower. Again, a liquidity rate moves lower. All of these are stop losses. People saw this fair value gap, shorted, got stopped, price went lower. Now, let's go back over here. What is time-based liquidity and why it's more important than just a random swing high and swing low? And once again, me telling you this, I've never heard a YouTuber or mentor tell you this or tell anyone this, but you're going to learn it for free here. Time-based liquidity matters, such as previous days, highs and lows, or a better example would be previous week's high and lows. Imagine you're sitting at home and you suddenly hear that Bitcoin has been going lower than its lowest price previous week, or like last week. Let's say the lowest price that Bitcoin was traded at last week was $17, just a random example. This week it's at $16. Isn't that discounted? That sounds discounted, which is why time-based liquidity matters. Players, big players, want to buy when price is discounted and sell where it's at a premium, where it's expensive. What was the lowest point or the lowest price that this candle here, this weekly candle here was traded at? The lowest price is at 70,475.57 cents. Price dips below that. Let's mark this out right here. I'm going to delete this. Go on before hour. And as you can see, price goes below here, right there, and after some time, based on weekly profiles, it retraces higher, and that can be seen with almost any week. As you can see here, there was liquidity built up right below this, it got swept. Why did price retrace back? Yes, it's algorithmic, but the algorithm is programmed to provide the institutions with this kind of movement. They want to buy where price is discounted. A good monthly example would be, for example, look at this case here. September, below the low. See how there's a big break. Sure, it could be because of this rally up, but we are considering the algorithm and the fact that it targets liquidity. There's a lot of concepts that are mixed in order for this to happen. Price sweeps previous month's low, drops into this zone because it has to rebalance it. They're buying this level because price is cheap. Where is the low of this candle? $14,056. Isn't that cheaper than $14,429? Yes, it is. That's where they start to buy. And as you can see, price started to move higher. This can be seen with almost every month that has its low swept. Right here, swept, starts to move higher. Where does it move towards after sweeping this? Over here and over here. Starts moving lower because it swept all these months. Where? Into this. Here, sweeps the high, fails to sweep lower. It doesn't do this every month. That's fine. Sweeps this month, starts moving higher. This happens every time. This happens with almost everything, and as we understand, the price is fractal. So this could be applied even to the hourly candles. If you have selected the right hourly candle. Now, the next point I wanted to talk about is, if I can find what I've written or what I've written, why is time-based liquidity important? And we just talked about that. The best buying and selling opportunities occur when the right liquidity has been taken at the right time. If you understand that everything with this algorithm is driven by price, or it's driven by the algorithm. I messed that up. Everything that happens in price is driven by an algorithm, and the algorithm has one main job. Yes, it has two jobs, but in this video I'm only talking about liquidity. Its main job is to seek liquidity and start moving higher according to time. We know that Tuesdays and Wednesdays are the highest probable reversals or expansions. Tuesday low taken, this low taken. Price is cheaper than Tuesday. They start buying. Price drives up into here and to previous week's highs. This is week 2 right here. Monday starting here. And this right here is previous week's high. Price drives towards the both sides at its curve because of liquidity. Because price was discounted here, it's cheap and it's expensive here. There isn't much more to talk about here. So does it help you? And now if you want to learn more, you can join my Discord. I have a Twitter as well, but I post random stuff there. I don't have much to sell you. I do have a premium channel on my Discord, but that's pretty much it. I'm going to teach most of the things for free, so I would appreciate a subscribe. So until next one, where I will be talking about, let me check, I'll be talking about the power of 3, and more. I'll see you until then.